Mike with Cox Financial Coaching. This channel exists for me to help you find ways to budget and pay off debt. Lately, I've been hearing a term on YouTube and other places called velocity banking. I recommend normally the debt repayment plan that people try to use is the debt snowball. And the debt snowball, we'll discuss it here in a little bit, but that is the method primarily recommended by Dave Ramsey to pay off your smallest debt, and then the next one, and the next one, and so on. Other methods have come around. Avalanche method, which attacks the debt with the highest interest rate. That makes sense for math nerds like me. But if we were truly interested in math, we wouldn't have got ourselves in debt to begin with. Velocity banking is a term that people have come up with, and velocity banking advocates will tell us that it is the best way, the quickest way, the cheapest way to pay off debt. Velocity banking is not the magic that everyone seems to think it is. I'm going to give you an example where it does work. And I'll get into it, but as a financial coach, our mission should be to help our clients find the best way for them to get themselves out of debt. In some circumstances, velocity banking may be the best method, or at least as good as another method. It's not always the case. We didn't get ourselves in the debt overnight. We started out with good intentions. I can afford the payment. I'm going to pay that off as soon as possible. Life happens. We don't make anything but the minimum payment. Time goes on. The balance increases. We spend money we don't have on things we don't need, and we find ourselves in debt. So let's talk about velocity banking. Here we have a client. They're pretty normal. They have $6,000 of net monthly income. This is the amount that comes in their paycheck or directly deposited to their bank account. They have $4,000 of expenses. This includes any debt payments, living, etc. That leaves them about $2,000 extra or leftover, we're going to call cash flow. Now, most people let this $2,000 disappear. They don't budget, they don't track their spending, and they wonder where the money went. But let's say, for example, this client has got themselves in this situation, and they are sick and tired of being sick and tired of every dollar they spend just disappearing. So they got themselves on a budget, which, by the way, I have another video that shows a very basic budgeting method. And what they're going to do is they're going to work as much as they can, spend as little as they can, and get themselves out of debt. Well, they've heard about velocity banking, and I'm going to show them today that velocity banking can work in their situation. But here's what they currently have in debt. They have $150,000 left on a mortgage. The mortgage rate is 3.25%, and their monthly payment is $1,500. Christy Van from Fantastic Finances and others have talked about mortgage interest. Mortgage interest is calculated one way: the current balance times the interest rate divided by 12. It is not front-loaded. There is no such thing as amortized interest or none of the other terms that some of the people who've convinced themselves that velocity banking is the only way talk about. Yes, when you have a $150,000 mortgage and you multiply that times 3.25% and you divide by 12, the interest on that is a large amount. It's not front-loaded. That's just the interest at that point in time for that balance of that loan at the percentage rate. You can look on page 3, as Christy says, or whatever, and look, oh yeah, I paid 2.5 times what I paid for the house in interest. If you pay just the minimum mortgage payment for 30 years, yes, you're going to pay a lot of interest. That's what the banks are thinking you're going to do when they give you a mortgage. They're going to make a lot of interest because if you just make the $1,500 payment in this example, you're going to pay a ton of interest over 30 years. But this month, every month after, the interest is calculated one way. The balance times the interest rate divided by 12. This client also has a $30,000 car loan. It's at 5.9%, and their payment is $600. They have a MasterCard, $7,000 balance. The interest is 28%, and they pay a minimum payment of $300 a month. They have a $5,000 Visa card. The interest rate is 22%, and they pay a minimum payment of $200 a month. So $1,500, $2,100, $2,400, $2,600 monthly they pay to debt out of the $6,000 that they earn. They have a total debt $150, $180, $187, $192,000. Not too bad, not too great, sort of kind of average in America today. So what we're going to do, we're going to use a method called velocity banking. This client has a good credit rating. They're able to go down to the local credit union and they're able to get a line of credit at 10%, $12,000. So what they do is they move 7,000 MasterCard, 5,000 Visa to this line of credit. The balance becomes 12,000. Now, some velocity banking advocates will tell you that credit unions don't charge for this. It's just $12,000 moved to a line of credit at 10%, and there's no fee for doing that. Some institutions may charge a fee for moving this debt, 3 to 5% in some cases. But let's just assume that in this case there is no fee. They eliminated $12,000 in credit card debt by moving it to the 10% line of credit. In doing so, they also eliminate these two payments, the $300 and $200, which means their monthly expenses go down $500 to $3,500, which means their cash flow increases to $2,500. So far we moved $500 in payments out. We have increased cash flow, decreased monthly expenses. Now we have this $12,000 line of credit and our car and our mortgage. So the first month comes in and we put our $6,000 salary into the line of credit. This brings the line of credit balance down to $6,000. And then over the course of the month, we add in our monthly expenses. Total for the month, $3,500. So right now, our line of credit balance is $9,500. Sorry for my poor writing, it's even worse on this iPad, but you get the idea. $9,500 LOC balance, and then we say, well, what about interest? Okay, in this situation, I am going to take the best possible scenario for interest, and I'm going to say that we only got charged interest on the low balance of the month, which was $6,000. And our interest is 10%, which is times 10%, divided by 12 for get the monthly, $50 interest. So at the end of month one, our line of credit balance is $9,550. Now then, what had happened if I had just recommended this client that they use the snowball method? The snowball method would have taken the $5,000 smallest debt. It would have applied their normal monthly payment, and I would have taken this $2,000 cash flow and applied it to the debt. So then you get down there, you got 5,000 minus their payment, minus the cash flow payment, $2,800. So on the Visa, their balance is $2,800. Well, what about interest? Let's take the worst case scenario, $5,000 original balance times 22% divided by 12, $92. So $92 would be the interest on the Visa card. Now then, if I took the best case scenario, $2,800 times 22% divided by 12, it would have been $52. Keep that in mind. Worst, best. Best interest at 50. Well, let's not jump ahead over there yet. Let's stick right here. So now we got the Visa card down to $28.92. But what about the MasterCard? Well, in the snowball method, all we're doing on the MasterCard is continuing to make the regular monthly payment of $300. So you got $7,000. You got 28% interest on that. $163 of interest. So what you got is the $28.92 plus the MasterCard minus the payment plus the interest, $97.55. So at the end of month one, worst case, you would owe $97.55 on the two credit cards. Using a line of credit at 10%, you would owe $9,550. So here we have $205 less interest paid using Velocity Banking. So there are some situations where Velocity Banking works. Almost every instance I can think of, it's when you move higher interest debt to a lower interest method, such as an LLC. So if this client wanted to get rid of these two cards, stop paying the 22% interest, and they could qualify for a line of credit at 10% or whatever percent, if it was 15%, it would still be cheaper than paying the 28 and 22. So they saved $205 in the first month by using Velocity Banking method. Now then, what else as a financial coach could I have recommended? I could have recommended they get a 0% credit card, $12,000, 0%. You transfer both the credit cards to that. You got zero interest. You do have a fee of 3 to 5%. By doing that math and using the balance they have at $12,000 and the $22,000 they have to apply, or $2,500 they have to apply to debt, by the time you paid that out in about 5 months, the math wouldn't work, and Velocity Banking would still be the most effective method in this situation. So here we are, typical client, typical debt, Velocity Banking, moving $12,000 over to a line of credit at 10% would be the best method for them at this time. Now then, what happens later when these two credit cards are paid off in about 4.5 to 5 months? We'll cover that in an upcoming video.